Hi everyone and welcome to Real Estate Investing in Canada. So objective of this course is to help you make your investments in the most efficient way. So if you haven't done it yet, please subscribe to our channel EduFin Wizards on YouTube. So we upload some free videos on YouTube so that you can learn and spread the message. So please do three things: subscribe to the channel, like the video and comment on it. It helps the algorithm and it helps spread the message. The whole course Investing in Canada is available on Udemy, so check out the link in description so you can enroll for the whole course that has all the free video plus additional some paid videos too. Okay, so let's start. So we are discussing REITs, so real estate investment trusts, and so we are going to discuss what are REITs, what are the benefits of investing in REITs, and how do they compare to physical real estate. So what are REITs? So you can view REITs as a real estate mutual fund. So what happens? Investors accumulate the money and they give that money to a REIT. So REIT, you can visualize it as a property management company. So it takes money from investors and then either buys residential real estate or commercial real estate. Sometimes it buys both. So it buys residential real estate like apartments, townhouses, then detached houses, right? So that it can rent them out. Or it can buy commercial properties like warehouses, office space, then let's say infrastructure. So it can buy commercial real estate. So it uses investors' money to buy these properties and it manages them, and whatever rent it collects, it shares the rents with investors as dividend. So basically structure is like a mutual fund. Investors accumulate their money, they give it to a REIT who is a property management company. That property management company on behalf of investors goes out and purchases real estate property. So like let's say residential real estate or commercial real estate, sometimes both depending on the REIT structure, and whatever income it generates from those properties like rental income, it will share that rental income with investors as dividend. So REITs are effectively an indirect way of investing in real estate. Okay, and you as an investor get benefit out of two things. You get exposure to real estate properties, right? And the yield from that, so the rental income from that, plus if the real estate properties appreciate in value, then REIT also appreciates in value. So that is like you get exposure to real estate prices. You get exposure to real estate income by using REITs. So as an investor, you can buy a REIT on a stock exchange. Okay, we are going to see some examples of REITs. So you can buy a REIT on a stock exchange. Now these REITs you can add into tax-free savings account. You can add these REITs into RRSPs, RESPs, first housing savings account, and as well as non-registered account. So the details of all these accounts we have covered in a previous video. So if you want to know more about TFSA, RRSP, RESPs, first housing savings account, then go to those respective videos and watch them. So if you add a REIT into TFSA, tax-free savings account means nothing is taxed. So dividends will be tax free, capital gains will be tax free. So whatever rents you're collecting from your REITs, those will be completely tax free in a tax free savings account. And if you buy a REIT and the real estate prices increase in future and you sell the REIT later on, so the gain you're making, the capital gain you're making, will be tax free too. If you add them in an RRSP, then dividends and capital gains will not be tax free, but you have to pay the taxes when you retire. In the retirement, when you withdraw the money, it becomes taxable then. You don't have to pay it right now. RESP, same thing. They are tax deferred. RESPs are used for children's education. So when the children withdraw money for their education, then it will be taxed. First housing savings account, dividends and capital gains are tax free, because first housing savings account is a combination of TFSA and RRSP. This is a new account that was launched by the government of Canada, so it is tax free. There is no taxes on that. Non-registered accounts, it will be taxable. So this is a great feature of REITs. REITs you can add into a tax deferred or a tax free account, right? So you can get real estate exposure. You are exposed to real estate prices, because if real estate prices go up, right, REITs tend to go up too, in line with the real estate prices in the market. So let's say 10 years from now, real estate prices have doubled in Canada. Probably REITs as a unit value will also double in Canada, because they represent that physical real estate. Along with that, you also get rental income in form of rents that are shared as dividends. Now that rental income also becomes tax free. So this is a great advantage of REITs. Now we'll see some examples of REITs. There are many REITs in Canada. There are many REITs that are listed on TSX. I'm covering just a few to get you an idea. In a future video, we'll discuss how to analyze a REIT, how to make that decision, what are the parameters to check REITs on. So in that video, I'll cover more of these REITs and compare them. But right now, I'm just giving you some examples. So Cap REIT, so Canadian Apartments Properties REIT, it's one of the biggest like residential REITs in Canada. So it manages approximately 67,000 apartments, townhouses and detached homes all across Canada and Europe. It has exposure to Netherlands. So how does it work? So it has bought properties in British Columbia, Alberta, Saskatchewan, Ontario, Quebec, etc. and some of it is in Netherlands. So it rents them out and it gets an average monthly rent from them of $1,100, and it shares that with the investors. Okay, so this is the REIT that we are talking about, Canadian Apartment Properties Real Estate Investment Trust. So if you buy this REIT on TSX on this day, so the price is $35. So if you buy it, you have to pay $35 to get it. Now, when you pay $35, what do you get? You become part of this REIT. So you have invested in a property management company of a sort. So if real estate prices go up, like they have gone up from 2005 to the present year, so REITs prices will also go up. So this is one advantage. Second advantage is rental income. So it pays a monthly rental income. So yearly rental yield is 3.14%, but it shares that rental income monthly. So almost 11 cents of income every month on a $35 purchase. Okay, or $1.10 of income every year. That is 3% rental income it shares every year, right? But the payment happens monthly. So when you buy this REIT, you get exposure to apartments all across Canada, right? If the apartment prices go up in future, real estate appreciates, you are exposed to that. Plus you also get a rental income. You can add it in your tax-free savings account, so the appreciation will be tax-free. You don't have to pay taxes when the prices appreciate and you sell later on, and also the rental income will be tax-free. Another REIT is industrial REIT called as Dream Industrial. So it has exposure to Canada, US and some Europe again. So it generally has warehouses, then all other industrial things, industrial components of real estate. So it manages that, it rents them out. For example, like Walmart is its client, so it has all the Walmart stores and warehouses. It manages it, it has constructed it, and then it is renting it out to Walmart. Okay, so this is an industrial REIT, little different than let's say residential REIT. So when you invest in it, you get exposure to prices of warehouses and prices of industrial land. Along with that, you get a dividend. So dividend rate is quite high as compared to residential. So it is 5.78% annually. Again, this one pays monthly. Okay, so these are few examples. So you can get exposure to residential or commercial using REITs as a structure. You can also buy a REIT ETF. Rather than buying individual REITs, you can buy an ETF that invests in different types of REITs and manages that for you. So example will be BMO equal weight REIT index ETF. So it invests in like equal amount, your money is distributed into equal amounts and you get exposure to REITs. So you can see over a period you get increase if the real estate prices go up, and you also get dividend of 4.5%. Okay, so what is the difference between REIT and physical real estate? So biggest advantage that REITs enjoy is you can hold your REITs in your tax-free savings account, which makes the gains and rents completely tax-free. You cannot hold a investable physical real estate in a tax-free savings account. So when you actually buy an apartment and rent it out, then that rental income actually becomes taxable at your own tax rate. So you have to pay taxes on rents, right? But REITs, you can add it in your tax-free savings account and that they become tax-free. You can get access to real estate with lower amounts. For example, we saw by paying $35, you get access to like the residential real estate market, which is not possible to do in physical real estate. You cannot buy a property for $35, but you can get it using the indirect way of REITs. There is professional management of properties. So property management is a big hassle if you are a landlord and renting your properties out, because you have to manage tenants, you have to manage their concerns, everything, right? So all that goes away when you invest in REITs, because there is a professional team that manages those properties for you. Then diversification across geographies. Generally, when you buy physical real estate, most of us are limited to the city that we live in. So like say you're watching this video out of Toronto, Calgary or Vancouver, you will be buying properties in respective locations like Toronto, Vancouver or Calgary. So your scope is quite limited. But when you invest in a REIT, you can get diversification. For example, Canadian CAP REITs, Canadian Apartment Properties REITs, it's invested in almost all provinces. So you get exposure to different provinces and different dynamics. Then finally, there is economies of scale. Economies of scale means that when you invest in a REIT, rather than buying physical property, if something goes wrong with the property, let's say the roof has to be replaced, or let's say there is some let's say appliances that have to be replaced, they can negotiate at a larger scale, right? So they might have contractors that they work on very closely, so they get better prices than let's say a small scale landlord. They also can negotiate with the banks for a better mortgage than like a smaller landlord. So there is economies of scale that can help you if you're invested in REITs. So what we are going to do, we're going to look at an Excel case study. So I'll explain the case study and we are going to compare investing in REITs versus investing in physical property. So let's first look at investing in REITs. So let's say you are investing as a couple. So there is partner one, he or she has a tax-free savings account limit of 81,500 because they haven't used their tax-free savings account ever. So 81,500 is the lifetime limit if you haven't used it ever. So both of them combine their limit and they invest 163,000 in Canadian Apartments REIT, the REITs that we saw. Okay, so this is let's say partner one and this is partner two. So partner one buys 81,500 of REITs, cap REIT, and the partner two buys 81,500 of cap REIT. So 163,000 is the total they have invested in this REIT structure. So as we know, it provides a 3.22% dividend, right, every year. So the dividend yield is 3.22%. Now average growth in real estate prices, if you see in Canada, they have been 6.11%. So this REIT should replicate that over a long period of time. So the growth in this REIT right, the growth in the value of this REIT should be 6.11%. So what will happen? 2022 they're investing $163,000. They get a dividend of 3.22%, right? So 163,000 into 3.22% will be the dividend. This dividend, since it is in tax-free savings account, will be completely tax-free. Next year real estate, let's say, grows by 6.11%. The dividend grows a bit, then after tax earning also grows. So such things are happening. So each year your real estate is going up, so your REIT is going up in value, your rents are going up, right? So your after tax returns are also going up. So the rents that it is sharing with you is also going up. So this keeps on happening. So let's say the next 30 years, if you invest 163,000 and it appreciates at 6.11%, you will be close to $910,000 in your account, right? In your tax-free savings account. Plus, at the end of 30 years, you in 2051, you would be getting almost $29,000 as rental income from this REIT. Okay. So in total, and along with that, all these years you would have also made some, right, rental income. So in total, your fund value will be $910,000 and your total rents received will be $443,000, right, in total, if you have just invested in this REIT. Okay. So same, and all of this will be tax free. So the value of that REIT, 910,000, completely tax free, plus all the total rents you have received in those 30 years would have been also tax free, because it is a tax free savings account. So this is a big advantage of REIT. Now, physical real estate you can buy with a mortgage and without a mortgage. So let's see what most people do. They buy with a mortgage. So you're putting 20% down, right? You're buying a property worth $163,000. Let's say it's a condo in Calgary or Edmonton, because $163,000 might not get you anything in Toronto and Vancouver, right? So $32,600, 20% down payment you're putting, rest you're taking as a mortgage, right? Now rental yield across Canada are 3.91%. They're a little bit higher in Alberta, right? But we are comparing gross Canada, so across Canada, so we'll consider 3.91%. And let's say your tax rate is 30%. Tax rates are important now because rents are taxable. So you buy a condo, it gives you out a rent, right? But since you're taking a mortgage, you have to pay interest expense on that. So I've amortized the mortgage. So this will be your mortgage, and I have calculated the interest that you pay in that particular year. So year one, you buy the condo, you get rental income, but you pay interest on that mortgage. So you make a small loss, which is effectively what happens, because interests are generally higher, right, when you start a mortgage. So you're and you pay taxes on that. So after tax, this is the amount that you are left with, because you get a little bit of a tax write-off. So same thing, the real estate prices might grow, the rent might grow, right? But everything is taxable. So after tax, you would be getting these much values, 30% tax. So what will happen at the end of 30 years, let's say your apartment has gone up from 163,000 to almost 910,000, 6% increase in real estate prices. But since it's a physical real estate, it's not tax free. So if you sell that apartment, you will have a capital gain, but that capital gain will be taxable. So you have to pay taxes on that 747,000 capital gain that you would have received in the next 30 years. Along with that, all the rents that you have received will be lower because you have to pay taxes on them. So let's say the last year you will get $35,000 of rent, but you pay taxes on it. So only $24,000 will be remaining with you. So the rents will be lower too. So the rental income will be $263,000. Okay. So when you buy physical real estate with mortgage, we see that the total rents received are lower than REIT, plus because of taxes, plus when you sell the property, you pay capital gain taxes, which you do not do if the REITs are in tax-free savings account. Next thing, if you buy the real estate without any mortgage, so there is no mortgage, so there will be no interest payments. You will receive, right, rental income, but you do pay taxes on that rental income. So you would have fund value, that is the real estate value. The apartment will be around 910 if it appreciates 6% a year, and you will have a capital gain. This will be taxed. Capital gain will be taxed. The rents you would have received all across years, but the rents will be $359,000 because you have to pay taxes every year on that rent. So if you just compare REITs, if you hold it in TFSA, 910,000 in line with real estate appreciation, and 423,000 lifetime rents you have received and completely tax free. Physical real estate 910, right, but when you sell you pay taxes, plus the after tax rents that you have received will be lower, and if you have no mortgage, still it is lower. So this is a big advantage that REITs enjoy over physical real estate investing, because you can put them in a tax-free savings account. Okay. Now, one last thing I have not covered in this video, you can do with a REIT, you cannot do with a physical real estate property, is the dividend you are getting, instead of taking it in cash, you can further invest it into the REIT. Okay, so you can, whatever dividend you're getting, instead of taking it out and putting it in your like savings account or something, or using it, you can reinvest it back into the REIT, and the growth will be higher, even more than that, right? Because if you do that, like let's do that, let's see what happens. So this plus last year's value, last year's rent, and if I just extend it out, okay, you would have around $2 million instead of 900,000, because each time you're getting a dividend, you're reinvesting it back into the REIT. This is a very powerful, this is called as dividend reinvesting. When we cover stocks, we'll cover this in detail, but dividend reinvesting can be done on REITs very easily. So every dividend you get, you keep on buying more. So effectively, the next dividend you will get will be higher, because you're having more and more units. So finally, you could end up with 210,000, and total rents tax-free received over the years $760,000. Okay, this is a great thing about REITs. Now coming back, so if you want to watch videos like this, please subscribe to us on YouTube. Our channel is EduFin Wizards, so please do subscribe. Then also like the video and comment, because it helps the algorithm and it helps spread the message. If you want the whole course, it's called as Investing in Canada. It is available on Udemy. The links are in the description. Okay, thank you so much for watching.